G'day, I'm John Dasley from CMK Accountants, and if you're thinking about buying or selling farmland in New Zealand, this video should save you serious money. Every month we see farmers get hit with surprise tax bills. They miss out on GST refunds or sign contracts that can create problems for years. Today I'm going to share the most common and expensive mistakes, plus exactly how you can avoid them. We'll cover farmhouse GST, the trap that can add $60,000 to your purchase price, and the contract questions that determine your tax fate, and the rules that affect almost every farm sale over $1 million. Stick around to the end and I've got a practical checklist that you can use for your next farm transaction. Let's start with your sale and purchase agreement. This isn't just paperwork. Every checkbox and every signature will actually affect your tax position. The first crucial question in any agreement is the vendor registered under the GST Act in respect of this transaction? And here's where people get confused. It isn't asking if you're GST registered. It's asking if you're registered for this transaction. If you're selling farmland used in your business, then that is typically yes. But if you're selling a residential property you own separately, you might answer no, even though you are registered for GST in your farming operation. Getting this wrong can be expensive. We've seen vendors who've incorrectly said they weren't registered with GST get hit with claims from purchasers who lost expected GST refunds. Next, plus GST versus inclusive of GST. If you're the vendor, plus GST protects you. Any GST gets added to the agreed price. If you're a purchaser, inclusive of GST gives you certainty. The stated price is the maximum cost. Here's one big problem that catches farmers off guard: farmhouse GST. Now, most people assume that their farmhouse sale is GST free. Now, in 99% of the cases, this is often true, but there is a massive exemption that catches people out. That is, have you ever claimed GST on farmhouse expenses? If yes, you'll likely need to charge GST on the entire farmhouse sale. Let me give you a real example. A $2 million farm with a farmhouse worth $400,000. If G applies to the farmhouse, then that's an extra $60,000 that the purchaser would potentially have to pay. The farmhouse is treated as a separate supply under the GST Act, and if you've made any GST claims related to it, the whole thing becomes taxable for GST. For the purchasers, ask specifically about farmhouse GST claims. Don't get blindsided by a tax surprise. Since 2021, most farm sales over $1 million need a purchase price allocation. This breaks down what portion of your price goes to different assets like buildings, equipment, crops, irrigation systems, etc. Why does this matter? Well, it affects your depreciation and tax position for years. Higher plant and equipment valuations give purchasers better depreciation claims, but often vendors prefer lower allocations to minimize depreciation recoveries and tax bills. If parties don't agree up front, the vendor gets first crack at setting the values and has 3 months to do so. If they don't act, then the purchaser can do it. It is very important that we agree this in the contract. It avoids disputes and gives both parties certainty. Most farm-to-farm sales in New Zealand are zero rated. No GST changes hands. But this only works if both parties are GST registered for the transaction. Now here's a red flag. If you're buying land from someone who is not GST registered, be very careful. We've seen the IRD later decide that the vendor should have been registered for GST, turning the purchaser's expected GST refund into nothing. Now, under contract warranties, they were successfully claimed from the vendor, but this is expensive. Another trap is contemporaneous agreements for livestock and equipment. If you're using different entities for land in a company and stock in a trust or something like that, you may have different GST treatments. You need to plan this carefully. Now, a quick word on lifestyle blocks. They're very different beasts. Income tax Unlike farmland, lifestyle blocks face the bright line test. The main home exclusion only applies if you use the land predominantly as your home for most of the ownership period. For GST, many register thinking it's going to save them money. Usually it doesn't. Unless you're genuinely running a business, compliance costs typically outweigh the benefits. Now here's your action list that you can use before signing any contract. First, get your accountant to review the contract. Understand whether it's plus or inclusive of GST. Plan the purchase price allocation early. If you're forming a new entity to make the purchase, then it's important that you get it formed early, get the IID and GST numbers immediately. During the process, you need to make sure you complete those GST schedules accurately. Ensure any nominees that you are going to use have proper registration and coordinate with the lawyers on tax invoices. There's a couple of red flags to watch. Vendors not registered for GST. Ask why. Make sure you've got clear GST treatment in the agreement and make sure there are no missing price allocations. Farm transactions are complex and the financial consequences of mistakes are high. Professional advice up front costs far less than fixing the problems later. At CMK Accountants, we help farmers navigate these complexities from contract review through to settlement. Don't wait until you've signed. Get advice early. If you have found this helpful, subscribe for more farming, tax and business tips. Questions about your situation? The contact details are in the description below. Thanks for watching, and remember that a bit of planning up front saves a lot of problems down the track. Until next time.